I am at SuperInvestor in Amsterdam on a day that's not rainy with Kevin Albert, who has been fundraising for the private equity industry for 30 years from firms like Merrill Lynch and now with fund of funds Pantheon. Kevin, the mood here today is really quite good, I would say. Private equity has more than proven itself in the last few years. Would you agree with that?
I totally agree with that, and I guess what's more important is we've had sort of a 6 or 7 year escape from the global financial crisis, which everybody is taking advantage of, both in the fundraising market and in the deal market, both mostly harvesting, but also making new investments. So the mood is very good compared to 5 years ago at this very same conference.
And it's especially good because everyone needs yield. At the moment, we still have QE, although that might end soon, and there has been a search for yield. And private equity has really delivered, yeah?
Yeah. Ever since I've been involved in the business, which has been since the mid-1980s, raising capital for private equity funds, there's always been a concern that there's too much capital flowing into the industry for the returns to be sustainable. And it's just never come to pass. The private equity industry has been so dynamic, and it's expanded geographically and by strategy and by number of firms. It's been able to keep that entrepreneurial spirit, the spirit of going in and being an invasive investor and changing the companies and creating returns which are incremental to what are produced in the public market. And at the end of the day, that's the job of private equity.
Pension funds have been especially hard hit by QE, and many of them are facing huge shortfalls. One of the things that you talked about in your presentation is the gap between the performance of defined benefit and defined contribution pension funds. Could you explain a bit about that divergence in performance and why?
Sure. Well, and there were a couple of points you made in your question. The first is private equity has demonstrably, by numerous studies done by various different people, proven itself to be the best performing asset class in defined benefit pension plans, certainly over the last 20 years, but I would maintain it's probably from the history of the asset class because of that invasiveness that I talked about earlier. And what we see are, first of all, there's this huge trend in pension land, if you will, of people being moved from defined benefit pension plans to defined contribution pension plans. Only 19 or 20% of private sector employees are still the beneficiary of a defined benefit pension plan, which is a pension plan that going to give you a paycheck for the rest of your life based upon your service and your salary over your term of your employment. They have now been placed into basically savings vehicles where they have to have a certain percentage of their salary deducted. Sometimes it's matched, sometimes it's not, and then they have to make investment choices, often only with mutual funds, to save an amount of money to provide for the retirement. And because most people haven't been taught from an early age to do that, the discipline doesn't exist, and the balance.
So people are looking at huge shortfalls.
The average balance of a 401k plan is $74,000. How long can you retire in Hong Kong or London or New York City on $74,000? Probably not even a year.
Sadly.
Now, there will be Social Security benefits, but as we all know, that's fairly nominal. The shame of the situation, in my view, or something that has to be rectified, is defined contribution plans have not yet committed to this asset class that has proven so successful for defined benefit pension plans, and yet both are 20 to 30 year long-term savings dollars. And that won't solve the entire problem. People still have to be more disciplined in how much they set aside. They have to be disciplined on the other investment choices they're making. But clearly private equity has to be at least an option, if not a requirement, in defined contribution.
So if I'm the general partner of a private equity firm, I look at the world and say this is a huge source of money for me, huge source of potential growth. I've tapped sovereign wealth funds, I've tapped high net worth individuals, insurance companies, certain kinds of pension funds, but not DC funds. Is it that simple? Do the people who are responsible for investing defined contributions have the knowledge to invest intelligently in private equity, to understand what the issues are, what they should be asking for?
It's a great question, and the answer is basically, as of today, no. General partners don't know how to approach DC plans, which are different and which will require modifications to the vehicle that you put in front of them to invest in private equity. And DC plans, because they haven't yet addressed private equity as an asset class, haven't learned anything about private equity, and aren't configured really to meet with managers. Remember, 401k plans were set up as an accident. They were established as an accident in 1978 when Congress changed the tax law to close a loophole having to do with deferred compensation plans. And as so often is the case, there was an unintended consequence. A benefits expert figured out how to use that tax change to create a new employee benefit. Not a new pension plan, but a new employee benefit, a tax-deferred savings plan, and it caught on like fire. It became very popular, and then another unintended consequence, corporations said, hey, wait a minute, maybe we can use that vehicle that we are now providing as an employee benefit plan to our employees and get out of the pension business and not be on the hook anymore for the results and for having a big staff. We can farm it out to Fidelity or Vanguard and basically wash our hands of it. And that's what's happened in corporate America. So there has to be a learning process on both sides, but even more importantly, there has to be a change in the 10-year lockup, fund-of-fund mechanism.
So private equity has to be a little more flexible to deal with this potential new source of money. And coming at it from the other side, what advice would you give for defined contribution plans? Every now and then the media focuses on fees, and the pension funds that are invested find themselves in the firing line. How could you pay these huge fees? And never mind if the returns more than justify the fees. What advice would you have for defined contribution plans as they look at the challenges of investing in private equity?
Clearly, one of the challenges in defined contribution plans where fees are a big deal, because that's where a lot of the lawsuits have occurred historically, will be in justifying the fees of private equity. And I think, at the end of the day, I don't think you're going to see direct general partners modifying their fees on a wholesale basis for this new arena. But the outperformance statistics that that have been established over and over and over again, and we may be able to show on a chart here, are net of fees. And net of fees, the outperformance is palpable, and I would say almost staggeringly consistent. And so defined contribution plans are going to, much as defined benefit plans, are going to have to be able to explain to their trustees and their boards and their constituencies that we are investing in this asset class. It is a somewhat higher expense asset class, but it is more than justified by the results that it's generating. And I think if you take people through how private equity works, which goes beyond the scope of this interview, they can understand it's the most invasive way you can invest your equity dollars.
Private equity has been a beneficiary of quantitative easing. We have seen, as a result of easy money policies, huge appreciation in the stock market, which has leveled off now. So final question for you is timing. You know, many of the private equity executives that I speak to privately worry that there will be a correction in the markets, you know, and that there may be a recession coming in the US. The US is still vulnerable to the uncertainties in the rest of the world.
Right.
What about timing?
So the way to think about private equity is the return advantage it gives you is a relative return advantage over a public equity benchmark. Most people use the S&P 500. If you're shrewd enough that, and you know exactly when this correction is going to come, and you can step aside, you should do it with everything you have. But we all know that very few people are able to do that. So you're probably going to, particularly in your 401k plan, be pretty fully invested. I mean, the bond market's going to be affected when QE2 ends, the equity market's going to be affected, and private equity will be affected. But what's going to be important is, can private equity still produce that relative increment over the S&P 500? And I would maintain the answer to that is yes. And I say that because if you look back at historical periods, we went back for the last 20 years and looked at every quarter and asked ourselves, would we have wanted to start a private equity program in that quarter, including the global financial crisis. And there were only, I think, 3 quarters in 20 years of looking at quarters where you would have said, nah, I wouldn't have liked to start the program in that quarter. Every other quarter, you would have. Some quarters it's better and the margin is bigger, and some it's lower. And the reason for that is private equity managers are creating events in these companies. They're doing things in the companies that create value. You're not just in a public stock that is totally influenced by the public stock market.
Thank you so much. It was a great
Well,
pleasure.
thank you. I enjoyed being interviewed by you.